Welcome, all of my friends out there in the real estate world. We are going to be talking today with our Integrity Home Mortgage's own Chief Strategy Officer and market expert. Cheyenne, can you say your last name for me?
Volatile.
Thank you for that. Um, So, Cheyenne, you are this amazing marketing expert. I have had the privilege of listening to your market updates for a year now, and I invited you here for our audience because so many people are confused about the markets. So, thank you for coming on. Would you like to say a little bit about your expertise and just anything to our audience before we get started with our questions?
Yeah, sure. I've been in the mortgage business, specifically on the sort of markets related side of the mortgage business for 25 plus years. Over those 25 years, I've worked at a handful of spots, including Fannie Mae and some large originators and large servicers. So I've got kind of a well-rounded view on, not just mortgages, but just interest rates in general. So hopefully I'll be able to give your audience some thoughts to chew on, some advice that they can utilize, and help them understand that whatever their needs are, Kellie Collins is the person that can address it for them.
Well, thank you so much for joining us today. Guys, he's really smart. Let's pay attention and take some nuggets out of here. So we came up with just a few questions, but if you want to take it somewhere else, we totally could. And so one of the things that I'm getting so many questions on is, hey, Kellie, the Fed just dropped rates. What's my rate going to be today? So, can you tell me a little bit about the correlation between the Fed and the mortgage markets?
Yeah. So it's easily to kind of conflate the two, right? You hear in the press people talking about the Fed's lowering rates, Fed's lowering rates, and then you go back and you talk to your credit card provider, you talk to your mortgage loan officer, you talk to your the finance guy at the car dealership, and that's not actually what's happening, right? So those rates aren't really changed, and so what you got to keep in mind one really important thing, and that is the Fed, it has within its purvey control over one rate, and that is the Fed funds rate. And that's the rate at which banks are able to lend to each other for overnight term. Um, every other rate that you and I experience on a daily market basis is based on, it's a product of the markets, right? So markets set every single other rate. And so while the Fed has some influence on where rates go, sort of over the longer term, day to day, it really is just supply and demand that dictates where rates are. So right now the Fed may be lowering rates, but as a result of lowering rates, the world kind of has this view that, all right, well, things are, there were bad things happening like inflation, and the Fed lowering rates takes the edge off of that bad thing, right? Lowering rates is going to solve that bad thing. So in the future, the economy will look good as a result of what's happening today. If the economy is good in the future, well, then rates should be higher, right? And so that's what happens. The Fed lowers rates to solve a problem. The world sees the problem as potentially being solved over the next 10 years, and rates on the back end, which is what governs mortgage rates, go up. It's logical when you think about it for more than a few seconds, but the press never thinks about it for more than a few seconds, right? Yeah.
Yeah, I think about it every day because people are saying, but Kellie, why is my rate at this point right here when the Fed just dropped rates? I should be 1% better or 1/4% better than what you told me 3 days ago. And then you
Yeah.
pull up I watch the MBS markets and the treasury markets and all of that. And you see this little pie chart. It looks kind of like a ping pong ball now. It's not much fun to watch most days.
Yeah, there's a lot of volatility out there because there's a lot of uncertainty, right? There's all sorts of things out there that are going to influence how the markets believe the future is going to shape up, right? Everything from inflation to employment to tariffs to whatever it is, right? I mean, anything that's in the headlines has a potential impact on the well-being of the U.S. economy over the longer term. And that well-being is what dictates what interest rates that consumers experience, what those end up being, right? Markets are never a view, a snapshot of what we, what the what the rates, what the economy looks like today, right? It's always a view on what we expect the economy to look like in the future, and that's why it changes everything.
Exactly. We've seen rates change even sometimes midway through the day. And so that's been kind of crazy. So when somebody is trying, so I have a lot of really smart clients and a lot of really smart realtors. And they go in and they read all the articles and stuff like that. When somebody is paying attention to things, you mentioned jobs, you mentioned inflation, you mentioned tariffs, what are some of the big factors that go into how rates are going to play out over the next month, 2 months, year? What are some of the things they should be paying attention to?
That's a real good question, and I'll start this by saying one caveat that changes, right? It changes over time as the problem changes, right? So right now, what's the problem, right? Why is the Fed doing anything right now, right? They're doing things because we've got an issue with inflation, and we don't want to kill what is a great overall economy, right? And so right now, the Fed is very, very tuned into inflation and jobs, which, by the way, is their primary goal, right? That their mission is to ensure price stability and set an environment in which full employment is possible. That is the Fed's job, right? So they're paying attention to inflation and they're paying attention to jobs. And so that's what we should be paying attention to as well, right? So if you're thinking about wanting to pay attention to inflation, then go out, Google economic calendar, and any economic report has the word prices in it is going to be a measure of inflation, right? As it's shown over the course of time, the change in prices. If you want to concern yourself with jobs, right? Well, then anything that has the word payrolls or jobs in it is going to be really important. So the first Friday of every month, we get non-farm payrolls, and that's the big headline number. But there's numbers kind of interspersed throughout the month. So jobs and inflation is what you want to pay attention to. It's what the Fed's paying attention to, and it's going to give us an idea of what the world is thinking the future has in store. Right now, right
Yeah.
now, when it comes to those things, good news for the economy is bad news for interest rates, right? So if we see a good jobs report, then that means that the Fed is that the economy is still healthy and the Fed doesn't have to go out and do things to ensure a healthy economy, i.e., cut rates, right? So rates should stay high because the Fed doesn't have to do anything. If inflation goes up, right, well, then the Fed is going to have to raise rates in order to get inflation to come back down, right? So bad news for the economy is good news for rates if you want rates to go down. That's just kind of rule of thumb right now. Again, over the course of time, it changes, but right now, that's kind of the environment we're looking
at. Okay, perfect. And so with that, are there certain targets that the Fed has mentioned that they're looking at, or just kind of
Absolutely,
what are we
there is.
looking at?
The Fed's got a very, very transparent target right now of 2% on inflation. They want 2%, over the longer term is the way that they phrase it. So 2%, 1% and 2% inflation doesn't mean that they need to hit it tomorrow, right? They want to see progress being made so that they can reasonably expect inflation to hit 2% over the course of time. And the Fed isn't a hedge fund or something like that, right? They don't need their return to come in today. They're a policy setting mechanism, and they can look at their mission over the course of years and decades. So they want to see inflation making progress towards 2%. In terms of employment, right? Because remember, it's price stability, so inflation and full employment. Full employment is kind of where we are right now, right? With an unemployment rate around 4%, that is what most economists agree is right around full employment. So they don't necessarily want to see weakness in the jobs market, but they recognize that since we're already starting at a place of full employment, weakness could be something that happens,
Mhm.
but they want to see progress towards 2%. So that's not really a number on the job side that they're looking for, but they've been very explicit that there is a number on the inflation side. That number is 2%, but it doesn't have to come from.
Okay, good to know. Now, I mean, inflation feels like it's a whole bunch more, being that it cost me $12 for a dozen eggs yesterday. But that's just me and eggs. Um, so, when we're talking to people, I am getting a lot of people that say, I don't want to be in my house right now, but I don't want to leave that 2.5% rate. We've kind of just expected that 2.5% rate, that was a great gift. Through COVID, the likelihood of that ever happening again is none. I mean, that was very, very weird anomaly. I can't say the word. That was a very, very weird thing that happened due to a global pandemic. Hopefully, we will not go through another one of those. And so when I'm talking to people, they don't want to lose that rate because then they're going to have to move to a house at 6.5%. I'm showing people that that doesn't matter because they also gained so much equity that we can just roll equity in. Even at 6.5%, they can have a similar monthly payment with their new house they're actually happy in. Maybe they have better neighbors. Maybe they have that extra bedroom for that extra kid, or maybe it has their dream kitchen. But a lot of people are stuck on these numbers. So when we're coaching people through what's going to happen with home prices in 2025 or home values, what do you see that kind of looking at in relation to where the markets are now and where they, well, we don't know where they're going, but where they could end up going?
Yeah, I think that's something that's on a lot of people's mind. The pandemic, the reason people are so stuck with the numbers is because the numbers have been that way for so very long, right? The pandemic was the end of, or kind of leading into the end of the zero interest rate environment, which started during the global financial crisis back in 2007, 2008, right? So we're talking about 15 years where rates were kind of at or near zero. 15 years where people could get a mortgage at 3%, 4%, 2% sometimes. And so it's been kind of a generation of buyers that are used to that being sort of the default. Now, if you look over time, it's not the default. It was absolutely, as you said, an anomaly. And to expect it to get back to that range in our lifetime is sort of hoping against reasonability right now. So getting back there, if you're waiting for that to happen, right, you are going to be sitting on the sidelines for the rest of your life. That house that's no longer serving you is going to no longer serve you for a really, really long time. No reason to punish yourself, right? To your point, Kelly, your equity position pretty much doesn't matter where you live in this country. If you've been in your house for more than a couple of years, you get a significant amount of equity. That equity can be rolled into a new purchase, and thus reducing your monthly payment. There are all sorts of different creative mortgage products out there that Kelly can counsel you through, that can kind of take the edge off of the numbers shock at the very beginning. But more than that, there is we live in a country that is great, and it allows for a really easy transaction around mortgages whenever it makes sense for that transaction to happen, right? So if today You get into a home because the home makes sense, even if the mortgage doesn't make it, only makes 95% sense. If the home makes 100% sense, you get into the home and you address the mortgage issue anytime you want, right? When mortgages go down, when you've got the need to take out money from the house, when you've got the need to send your kids to school, there's all sorts of flexibility because mortgages these days no longer really have a lot of the impediments they had in the past, where there was prepayment penalties and stuff like that. It's entirely your option as a homeowner to refi your mortgage anytime you want for any reason that makes sense to you. And one of those reasons is that rates go down. Look, we've had a really dramatic move in interest rates in a really short amount of time. And that's why there's a little bit of whiplash. The fact of the matter is that we're actually at rates that are historically normal. So it is entirely possible that this is where we end up for a really long time, right? With mortgage rates kind of around where they are right now. One thing I can tell you along the lines of home prices is we have a serious housing crisis in this country. There's so many people whose homes are locked up in these 2 and 3% note rates, 2 and 3% mortgages, that just don't ever feel the need that they should sell. And so there's a significant amount of the housing stock in America that is potentially never going to come back to market, at least not for the next several years. And so there's always, we're still manufacturing as a country, 24 to 35-year-olds that want to get out on their own and buy their own homes, right? And that happens every single year. People turn, between 24 and 35, and they're getting married and they're having kids and they want a house. But we've got a bunch of the housing stock that is locked up here that's not going to come to market. So we've got demand, but we've got no supply. And that imbalance, right, that we've been experiencing, that's been driving home price appreciation over the past several years, is not going anywhere anytime soon. That portion of housing that is locked up is really only going to come to market if people are, in the event of a divorce or death or something like that, right? I mean, it's just natural causes. It's not just, willy-nilly, hey, I want to find a house and I'm going to go do this now, like there used to be when every mortgage was 2%, right? So that inequity, right, that imbalance between supply and demand offers a really, really supportive environment for home prices. So home prices are the path of least resistance for home prices is for them to continue to appreciate because there's always demand and there's not going to be supply for a really long time. There are some places where builders are doing a better job of meeting the supply by building new homes. But those places are few and far between. Most of the country is not doing nearly enough. Most builders are not doing nearly enough to satisfy the demand for housing that's out there. So you may not like the rate today, but if you love the house today, you can pretty much bet on the fact that next year, if you get comfortable with the rate, that house is going to be more expensive. Every year you wait, that house gets further and further out of your grasp. And so it really does make sense. The old adage, right? Marry the house and date the rate, right? That makes a whole lot of sense these days.
Absolutely. And I actually have had this conversation with, I don't know, probably 50 people over the last 4 months. And we have looked at the last 73 years of real estate and the appreciation levels. Only 7 years in the last 73 have homes not appreciated. And if you didn't buy, and if you bought at any point in those years, even if you bought right before home prices crashed in, what was that, 2008, you still came out ahead if you held your home for 4 years. Just like the stock markets. If you take your money out when it crashes, you miss that bounce back up. So real estate's always a good investment. And just making sure that you can afford it is really the thing. And so that's what I help people with, is trying to figure out how to afford it. And a lot of times during that, hey, we're going to move out of this house and move to this next house, But wait, we did like everybody else. We ran up the average household incomes 20, our average household has $25,000 in credit card debt now. They've got a mortgage payment over not a mortgage payment, a car payment over $800 a month, which my first mortgage payment wasn't even that. But what we can also do with equity is if your house payment with the mortgage rates is gonna be $700 to $1,000 more than what it is now. If when we take that equity and we pay off these other things, you're still coming out light years ahead because you're reducing your overall debt load. So I think right now, the focus should be paying attention to not just that home and what that interest rate is, but the overall debt load that you have and the overall interest rate you're paying. Some of these credit cards are at 30%.
Yeah, that's a really important point, Kelly. I think it's great that you're talking to your clients about that because I think that's one thing that, when you talk about the sticker shock on mortgage, let's be honest, right? Even at 7% or 7.25%, mortgages are still pretty much the cheapest debt you're ever going to get, right? And oh, by the way, you also get to write off the interest. It is absolutely the cheapest debt that's out there. Pay attention to your overall financial picture when it comes to borrowing across all of your credit lines, right? Your line of credit with your bank, your credit cards, your cars, your student loans, right? Because the interest rates have moved on most, if not all, of those obligations you've got, and so people kind of forget about the fact that you may have sticker shock in the mortgage place because you're shopping for that. But meanwhile, in the background, all of your the cost of all your debt has gone up without you even thinking about it. So, Kelly, your ability to help folks with being able to consolidate some of that debt and shift this really high consumer debt they've got into mortgage debt, which again is the cheapest debt they're going to have, the highest quality debt they're going to have, is absolutely essential.
And we even look at what the rate comparison is. If we average out the rates on this consumer debt and the new mortgage versus that 2.5% mortgage, you're still coming out 5% ahead most times at
Yep.
current mortgage rates. And so when we are, so basically, when we're trying to help people pay attention to their financial load, pay attention to debts, pay attention to all of this. I've got realtors out here who are freaking out saying nobody's ready to buy. How do we really, what's the best way to educate somebody on how to buy? I mean, is it doing that one-on-one consult? Can our realtor partners help get better education out there? What are some of the ways that we can really help consumers understand that it is a good time to buy? Anytime's a good time to buy real estate.
Yeah, I think the point you made earlier is a really powerful point, and that is it is historically been very, very hard to lose money in real estate, right? Especially when we're talking about your primary home, right? A home that you're not going to just flip and you're looking to make a buck on real quick. If it's something you're going to be in for a while, it is nearly impossible to not make a good decision when it comes to buying real estate. In terms of value, right? Maybe the house, if you make the bad decision, the house doesn't work for your family, right? That happens sometimes. Uh, but from an investment perspective, it almost always makes sense. I always recommend a little bit of belly to belly one-on-one consultation when it comes to a financial transaction of this size because let's be honest, you're great at what you do. You do a ton of loans every year, and just like when my wife and I had our first kid, right? The OBGYN came in and 1, 2, 3, she knew exactly what she was supposed to be doing, and she was really quick, and she got the baby out, and out the door she went. Meanwhile, that was the biggest day of my life. It was the biggest day of my life. It was the 30th baby that she had delivered that day, right? So you got to put yourself in the borrower's shoes, and while you do a ton of these every year, and your realtor partners sell a ton of houses every year, it is always the biggest transaction that your client is engaging in. It's a big deal for them. So counseling them through what makes sense, understanding how to look at things, that it's not just about where the rate is today versus what your uncle got 5 years ago or 8 years ago. It really is about what makes sense for you in your financial situation with your goals in mind. It's buying and selling homes is not a widget factory, right? I mean, everybody's situation looks a little bit different. Everybody wants to feel taken care of, and ultimately we offer something that everyone needs, right? That everyone wants, and that is access to the most efficient financing possible for the home that they love, right? The place they want to call home, they want to raise their kids. Sometimes that financing costs a little bit more, and sometimes it costs a little bit less. But in today's environment where the house makes sense to you, right? It doesn't matter where it was, and it doesn't matter where it's going. What matters is you're getting a great deal today. That every day you wait, that deal becomes less and less great because the home prices are going up and up and up. And while there's no assurance, obviously, of anything in life, including that home prices go up for forever. If the house makes sense to you and you're going to be in there for a long time, 73 years of data tells us that you're likely to be safe from an investment perspective. And the moment the rates make more sense and there's access to something even more efficient than what you've got Kellie's number, right? She can help you fix that.
And I mean, we're not financial advisors, but I heard somebody joke about this the other day, is that if you own a bunch of crypto but are waiting to buy real estate, you need to go get some advice from somebody. Because crypto is so volatile, people have lost so much money in like a day, where real estate, you've got to have a place to live. Everybody has to have a place to live. Might as well have it working for you like a savings account, because a little piece of that money you pay every month goes towards your equity, plus the market goes towards your equity. And I specialize in reverse mortgages. So particularly for people going through divorce. And so I've met with so many elderly people, or not even elderly, just people age 62 and over, that are coming into retirement and they're scared because they saved money, but they didn't save enough. Social Security wasn't enough. And now they're going into retirement and they don't have the money to pay a mortgage, plus not have a job. So that's where great financial products and looking at it before you get to that point, working with your whole team. So I am a little bit unique where I'm a big old nerd. I finished all my certified financial planning classes, all that kind of stuff. So we work with financial advisors, your CPA, your attorney, your estate planning attorney, and we can work together to see how the mortgage and your home equity works there. Because the sooner you buy a house, the sooner you start building that equity so that it can work for you when you decide to retire, instead of not being able to retire because you still have a mortgage payment, not enough equity to do anything with it.
Absolutely. And the reverse mortgage product is one that is incredibly helpful, and people just don't really understand it. I think it's very misunderstood. I think there's not enough folks that have, because on its surface, it seems too good to be true, right? That your house pays you rather than you paying for your house. Well, think of it kind of like a reward, right? You spent years and years and years of your life working hard and paying your house down. And now it's kind of like taking out a staged, home equity loan, right? Where it will pay you based on, pay you back some of that credit you built by paying that house off in the first place, right? It's an allowance for the hard work you've already done. And ultimately, right, that house still is yours, right? And at the end of the term of
100%.
that reverse mortgage, that house is still yours, and it's an asset that you can still will to your kids and things like that. It just might look slightly different from, it may not be fully paid off, but there's always opportunities for your heirs or your estate to still capitalize and transfer that wealth if that's your concern. If your concern is to, to be able to live the way that you want to live in retirement, then it's an incredibly efficient way of extracting some value out of that house, that the value, by the way, that you built in the first place.
Yeah, so you're using that to reward yourself. So, something I have been very focused on lately is talking with the 20 somethings, the 30 somethings about buying a house so that you can get there and have more options. Because I meet with too many people in their 60s who are getting priced out of their rental situation on their fixed income, and then they can't afford to buy a house. I have this very unfortunate woman, her husband passed away. They were renting a place. Now she can't afford to live. She's having to move in with her daughter, and that she said this was the last thing I ever wanted to do. So, everybody, let's look at your house. Let's look at your consultations. And so, Cheyenne, thank you so much for all of this. One last question for you. Can you bring out your crystal ball and tell us where rates are going to be this next year?
Um, it's a really great question. And I always have an opinion on this. I seldom share this opinion because uh, I don't need everybody to jump in front of the trades that I have on my personal account. But here's what I'll tell you. I think that right now we're at a spot where the 10-year treasury has gotten to a place where it's kind of taken a rest here several times over the course of the last year or so. We've got a Fed that has acknowledged the fact that they're at a place where they don't think they should be doing anything else, and that so they've officially paused their rate cuts back in September, right? Or sorry, December. They paused rate cuts, and so you've got a Fed now that's sitting on the sidelines. You've got an economy that seems to be very, very healthy, right? I mean, we've made a ton of progress on inflation. There's still more work to be done, but we've made a ton of progress. And if you look globally, we are doing much, much better when it comes to battling inflation than pretty much any other industrialized country. And labor markets remain really, really healthy, right? So if the economy stays where it is, the Fed, as a result, is uninclined to do anything more, then this kind of makes sense for us to kind of take a breather here and stay in this range for the foreseeable future. I think the Fed only gets back in and starts to cut rates again if we see one of two things, right? Either a rapid progress back down towards 2%, or a significant deterioration in labor markets, right? So if we got a lot of job losses or inflation comes down really, really fast, neither of which seem to be happening right now, then the Fed comes back in. But we're going to have months, right? Because it's not going to be a data point that the Fed looks at and says, here's now, we've changed our mind. It's going to take some time for the Fed to build up a track record that says we're clearly headed in this direction. We're headed lower here. We're headed higher there, right? They got to see a trend. So when the Fed gets back in, we're going to already know. We're going to have seen that trend as a country, as as market participants. We're going to have seen that trend right alongside the Fed, and then we'll have a great, we'll have a really long runway that says, yeah, we know the Fed's getting back in. Up until then, I think this is where we're at. I think mortgage rates are likely going to stay right around here, plus or minus, call it 25 basis points for a good loan model.
Okay, perfect. So, I mean, that's what I'm hearing across the board, and thank you so much for confirming that. And so, to my realtor partners, if you need help trying to help your clients figure out how to afford a home, or to my divorcing clients, if you are trying to figure out how to afford the home, that's where I come in. Let me come and help you. I can help you strategize. We can talk about rate buy downs. So if you have a home that's really unaffordable, or you really can't afford a certain mortgage payment, if we can get a seller to contribute we can look at lowering that interest rate and possibly making it more affordable. So give me a call. Let me know how I can help you figure out those things, because it's not just here's your rate and let's go. When you ask me what the rate is, we have to know all the parameters around it, and I can help you figure that out. So thank you so much for joining us today, and I hope you found all of this helpful. If you have any questions, give me a call. If I don't know the answers, I know exactly who I can go to get those. So thank you so much for today and for joining us.
Thanks, Kelly.